might be a little bit shorter than what we did with the annual market report, but we've divided it into 4 sections. And we're going to go ahead and kick things off with the first section, an economic summary. So a little bit different in terms of the order, but I'm going to give you what you might call the elevator speech about how the economy is doing and how the markets are doing. And if you've got anybody else at home that couldn't attend this, or you're telling somebody about this event, you can say, well, let me just share with you what's going on in the markets. And that's what we're going to cover here first. I kind of like being able to get to that right away. The headline is Strength Despite the Federal Reserve, although I did just catch a headline today that maybe the Federal Reserve is starting to agree with us a little bit, and maybe they're not going to have to raise rates much or even any more at all, which would be terrific. But despite all that the Fed has done, I think they've overreacted a bit. The economy is in pretty good shape, and let's start with looking at employment. I'm going to show you 2 slides here. The first slide is just the headline chart there in blue, where you see that the unemployment rate is extremely low. It's been low for a while. It's continued to head lower. We have an incredibly strong market if you're a worker. So most workers have been able to find the jobs that they're looking for. In fact, the unemployment rate is so low that it's well below both the Federal Reserve's and the CBO's estimate for what's full employment. So we're below the theoretical minimum numbers that you could even have. And that's actually a problem at this point for many businesses that would like to expand at a faster rate. So we could probably take some bad news there, what would normally be bad news, just to see that market loosening up a bit. On the next slide, I'm going to add a refinement to that. There's been a narrative at various times in economic cycles where people will say that folks just don't want to work. And maybe that has been true in the past. It's definitely not the case now. We can measure that mathematically with what we call the participation rate. And we've been able to chart for decades what the maximum participation rate should be. That's when we look at all adults that are eligible to work. They could work, they're not incarcerated, things like that. They're not in the military. So this is a civilian participation rate. And say what percent actually choose to be in the labor force. And what you can see with the black line there is we're now back up above the theoretical maximum participation rate. So more people have come off the sidelines due to higher wages and maybe really good working conditions, things like that, to join the labor force. So we've got more people working than we would even expect, and still the unemployment rate is below its theoretical minimum. So an incredibly strong labor market. Another thing that the Federal Reserve is in charge of is the inflation rate. And the headline here is that it's stable. And I'm saying that it's embedded, meaning it's now pervasive throughout all supply chains. So hard for it to move down at a rapid rate, but it has been declining. And I'm saying that it's embedded, but at a 3 to 4% rate. Now, we've not seen any numbers that show it below 4%, but there are some things moving through the economy that I think are going to bring it into the 3 to 4% range here in just the next few months. So the next few monthly releases are likely to start to show you a number that begins with 3. And then I think we're going to stay there for perhaps many years to come. So I'm not exactly sure what the Fed has seen today where they're saying they can stop raising rates. They've probably already raised rates too much. These solutions are coming through capitalism and innovation and so on to bring the inflation rate down. It's really not what the Fed is doing. But nevertheless, hopefully the Fed will stop doing what they've been doing. So inflation is stable at 3 to 4% above the Fed's historic target that's closer to 2 or 2.5. But the days of runaway inflation are over. One bit of data to support what I'm telling you about inflation is just what's happened in the last quarter with commodity prices. Now, that's just one input. The cost of labor, which is not coming down all that rapidly because we don't have enough workers, is another. But just looking at commodities and how that filters through, you might not have even known that natural gas prices dropped by more than 50% in the last 90 days. But you can see the overall trend across a variety of commodities. Sugar prices are sort of set by a cartel. Maybe that's not the right word for that, but it's not quite the free market that you see for some other commodities. That's up. I don't make too much of that. But most commodities got cheaper. And in fact, if you peek over there to the table on the left, you'll see that over the last 1 year, commodity prices are down well into the double digits. And that's not reflected in many inflation measures right away, but it does put a downward pressure on things. And so that's just one of several reasons that I think you're going to see things drop into the 3% range. Economic growth is a measure that we're all thinking about, and in the long run, performance of the stock market is related to the rate of economic growth. And it can be a bit frustrating when we hear headlines from people that are not in the financial media, maybe they're in the broader media, and they might say things like the economy is trending down, or really just botch the headline there. What we're really seeing is that the rate of growth is trending down. And again, if you come back into what are the classic inputs to production, it's natural resources, it's labor, it's capital. These days, maybe it's technology and a few other things. What we're seeing is that we just don't have enough workers. We don't have enough labor to grow the economy any faster. And so if we had more people, we could grow it faster. And again, that's one reason we could tolerate a number of months of what historically would be bad economic news, a soft labor report, because there's so many other businesses standing by ready to hire any workers that come into the marketplace. So the rate of economic growth has trended down. The blue line is gross domestic product, and that's always the official number, but it takes weeks to get that number out for the prior quarter, and then it gets revised twice. So we're so many weeks past things by the time we get the real number that it can be frustrating. However, we can just look at the weekly economic index, and we can know on a weekly basis exactly where we're at. The long-term correlation of those two measures is very, very tight. So what we see right now is that the economy is growing at a rate that's above 1%. And if somehow we could find more labor or more productivity, we're going to talk about that in a minute, we could see the rate of economic growth actually pick up. An important conclusion about any comments on the economy would be whether we think we're going to go into a recession or not. And I've been saying for close to 3 years that I'm just not seeing this recession. So a lot of voices have said they thought we might be about to go into a recession. But again, I've been hearing that for so many quarters now that I don't make too much of that. I think there's just a lot of folks that might see softness in their particular economic arena and want to extrapolate that to the larger economy. But we've never been in a recession where we had a labor market that was this strong. What I'm showing here on this slide is the stock market in green with monthly returns and the Fed's prediction of a future recession in red. And you've seen a few recessions get so deep that number did get to 100%. But in every instance, going back through history for far longer than this particular chart depicts, we always get a bit of a warning. So the pandemic was the exception to that. But if you go back to all the other recessions, you see that red line start to tick up before the actual recession is declared, and in many cases before you even see any serious damage to the stock market. And so right now, the latest release shows that the Fed is giving us less than a 1% chance of a recession. So it's been a very reliable indicator. I couple that again with an ultra strong labor market and the fact that we've just not seen recessions when we have so many people working. You really just can't. To be fairly confident, at least for the next few months, that we are not headed for a recession. And just to wind up with our economic summary and talk not so much about the economy, but really about the markets themselves, this is the second quarter in a row where we've had really good capital market results. We've made money in fixed income, we've made money in the stock market. For the first 3 months of this year, the global equity index was up 6.95%. And kind of surprisingly, we made money in the fixed income market. we know that rates are up, but that is reflecting an actual decline in most interest rates. And when rates come down, whatever you already own in the fixed income market tends to become worth a little bit more because you've got a higher rate than the new market norm. So we had a 3-month period there that's almost a pretty good year in both fixed income and the stock market. That's after a very strong fourth quarter of 2022. And those 2 quarters back to back have been so strong that they have almost, but not completely, wiped out the 3 really bad quarters, the first 3 quarters of 2022. If you now look at the 1 and 3 year numbers, it doesn't look too bad. In fact, the 3 year numbers for the stock market look terrific at 15.64% per year. The fixed income numbers still don't look too good because we did spend about a decade at interest rates being very near zero, and there's just no way to escape that. Eventually, the returns you get in fixed income reflect current interest rates. So let's pivot a little bit to our key themes for 2023. We rolled these out last quarter at the annual market report, but what we say is that stocks are a hedge in a changing world. Equity owners have always been the winners. As I just covered, fixed income is normalized a bit. Inflation's down, rates are up. I want folks to be aware of massive disruptions coming in individual stocks from innovation. And lastly, with private markets, it could be a great time to buy. Now, in a minute, we're going to get into some of these issues in more detail, but I do want to emphasize, because I think this is our last chance to talk about it too much, is what's going on in private markets. When we say it's a great time to buy, that is a reflection of the fact that in many parts of venture capital and private markets, the damage has been far greater than what's been happening in the public markets. So we put up public market index returns, but things have been very dicey for a number of firms that are involved in the venture capital world. That's not been the case for our clients and the investments that we have helped them to get into. So our clients are coming at this kind of disruption, maybe even a recession, if you will, in venture capital from a tremendous position of strength. And so as our clients come into this with strength and look at that disruption, I'm reminded of the Berkshire Hathaway philosophy, and Warren Buffett likes to talk about when other people need cash and you've got the cash, you get to make the rules. And that's really what's going on in venture capital. So there might be some of the very best entry points occurring in 2023 than we've seen in many, many years. And that's really across private markets. So that's in the equity side with venture capital in particular, but also on the private fixed income side, or private credit side, as we call it. If firms that are entering into new deals last year expected to earn just barely into the double digits, they might be able to add another 5% to that expected return. So if you've got money that's on the public side and you were thinking about putting it into the private side, this could be a terrific time. The other thing that's going on in private markets is that there are some structural changes or product changes, if you will, that are going to allow people to enter that market, but then exit that market or get liquidity at times that are more appropriate for them. So I think there's a lot of folks in our client base who maybe have just stuck a toe in the water for private markets, or maybe their total private market exposure is 10 or 20%, but that's been for liquidity concerns. Maybe now that could be 30 or 40 or even 50%. Every client's in a different position, but changes to product type could allow folks to do even more in there than they've done before. So it could be a really good time to ramp up those types of investments. Now we're going to do our market recap, and the headline there is looking for a new normal. We're going to move a bit quickly here, but let's just start with what's happened in the last quarter with our timeline of events. There were all sorts of headlines to look at, or you might even say be distracted by. For instance, from the investor standpoint, I'm not sure that headline in the middle about the Chinese spy balloon is going to be something that we're thinking about too much in the future. What I think is important is what I've put into green or what I've put into red. And I put the headline about France in green because they're going through all of the repercussions of moving the official government retirement age from 62 to 64. And I think Americans could be forgiven for chuckling a little bit at that. That seems still awfully young when we're considering moving ours from 67 to perhaps as old as 70. But I think it's good in the sense that governments do need to match their expenditures to the tax revenues coming in. And of course, there's a battle going on over that right now in our own country, as there often is. I put other headlines in red that I think are bad news. For instance, twice in the quarter, the Federal Reserve raised interest rates by 1/4 of a point. And as I said a minute ago, I think we're already at least 1% too high in terms of our overnight rate. You'll also see some headlines in there, and we'll come back to this later in the presentation, about banks having all sorts of problems because how they have managed investor deposits in terms of where they've put money. And I think I'm going to be tempted to do a whole quarterly market report about the banking industry at some point here. If things get substantially worse, that could be next quarter. I'm always happy when I get all green arrows showing that every part of the market, the riskier parts and the safer parts, all went up. Always like to set some brackets there, or the best and the worst, at least over the last couple of quarters, of what a really good quarter or bad quarter looks like. And I'll remind you that in 2022, we set multiple records for how bad the fixed income market could be. There's a lot of reasons for that, not the least of which is that the Federal Reserve was stimulating the markets for way too long and then had to play catch up. And that's one of the headlines that bank investment officers were trying to deal with, is a very dramatic rise in interest rates. And in the first quarter of 2022, the U.S. fixed income index was down 5.9% in just 90 days. That did a lot of damage to bank balance sheets. But this last quarter was much better. Rates fell just a little bit, despite the Fed raising the overnight rate 2 more times. And so from an investor standpoint, the last quarter was terrific. Within the U.S. markets, we saw this looking for a new normal phenomenon play out, where growth stocks had been hurt so badly that they sprung back just a little bit, and the massive outperformance of value stocks came back a little bit more towards the norm. That value outperformance is still the story for the last 1 year, but at least for the quarter, growth stocks came back a little bit from some pretty bad price and pretty bad market dynamics. That story in the U.S. market was the same story that we saw overseas, where growth stocks did better. There's a lesson here that says just be diversified. You never know over any given short period of time where your market returns are going to come by. Certainly different places the quarter before this quarter, but for diversified investors, they were just able to enjoy the overall trend of the markets moving up. Not a completely different story with emerging markets, but not so much of a growth rally there. Pretty even across all parts of the market. However, if you look at the 1-year trend, certainly the best performance was again on the value side. REITs, which are an asset class that we have lowered our allocation to from a previously low 5% of equities, it's now even less than that, closer to 2%. What we can see is that the quarter gave us just a little bit of a return. Our overweight to the U.S. definitely worked to our clients' advantage, but we're a little bit concerned about commercial real estate and office space in particular. So we're being proactive there by lowering that allocation. Again, it was small to begin with, and now it's you might almost call it a token allocation. Fixed income markets continue to be the most interesting part to many investors, because that's what's driving a lot of what happens on the equity side. What you'll see in the top middle part of this page is that interest rates now, that's the blue line, are below where they were a quarter ago, at least for most time periods on the yield curve. Because we already saw the Fed raised rates twice in Q1, but yet the longer parts of the curve, the parts where the market sets the yield, have declined. And whenever you see this dislocation or a big bend in the curve, where the short-term rates are massively different from the medium and long-term rates, what you can know for sure is that the Federal Reserve does not have that short-term rate where it needs to be. So a year ago, the short-term rate was too low. They were overstimulating, and long-term rates were much higher. The Fed waited too late to catch up to the market. Now the Fed has gone way above the market, and as they continue to raise rates, longer-term rates are actually falling. The market is calculating the probability that the Fed is just going to take this to an extreme. So that is a common thing for the Fed to do. They go too low for too long, then they go too high for too long, and they're always playing catch up and just behind the curve, if you will. That definitely is what it looks like right now. And so that's a recap of what's already happened. And already we're into our look at the future. And the market outlook for the future is one of preparing for disruptions, which means, stick to your financial plan and trust us that if markets are up, we're taking profits for you. But let's get into what these disruptions might be. So if the headlines are coming out, you've already heard about it and thought about it. So the first is about commercial real estate. The work from home trend and some other things going on in that market means that we're seeing real pressure on the value of office space. And so if you own Class A office space in a hot region that's growing, you're probably fine. But if your particular space is not so competitive, could be in real trouble. We've got a chart here showing that quarterly construction starts are continuing to decline. We'll see as we get throughout the year if that gets even worse. But these things have a life of their own. They have momentum, if you will, even during the pandemic. Couldn't just shut down all of the projects that were out there, but higher interest rates and work from home are meaning that a number of leases are going to come up for negotiation, and we might see that real estate prices are pressured. And anyone that's ever been involved in real estate knows that the trend is that a lot of real estate is financed by debt. So you might ask yourself, not just what happens to the equity owners of commercial office real estate, but what happens to the folks that lent money to that. And unfortunately, that's depicted on the next slide here. It is, of course, the banks. They're not the only source of lending to real estate, but they're a big source of it. And so just as banks like JP Morgan went out and locked in low rates for the long term, unprepared for the Fed, they own real estate loans as well. So we're looking at big unrealized losses. Then you got firms like Schwab out there that people might not have even expected to get into trouble with what's going on. Estimates for what this looks like in the broadest sense for U.S. banks have been anywhere from Bloomberg's estimate a few days ago to $620 billion in unrealized losses to Fortune's estimate a week before that says it's $1.7 trillion in unrealized losses. So we know there's a big problem. Some of it is, again, from taking depositor money and locking in very low long-term rates, unprepared for what the Fed was about to do. So even though we warned all of you, apparently these banks were caught a bit flat-footed, but also it's related to lending that overlaps these problems in commercial real estate. Other issues that are in the news and you want to be aware of include what's going on in Ukraine. And we've been talking about this for over a year because it's now been more than a year since Russia invaded. The headline here is, will Putin realize his finite game can't win, and what next? What we're talking about there is this idea that you see expressed in game theory, where you have a conflict typically with two sides, and one side is playing what we call the finite game, but the other is playing what might be called an infinite game. And in this instance, I think it's Putin that's playing the finite game. His goals are rather short term. One could certainly reasonably conclude that Putin is a man of great ego and is seeking political power and is being driven by a likely unrealistic expectation that he can regain the perceived glory of the days of the Soviet Empire. And so that's driving a lot of his actions. The man is getting older, and he's got only a certain number of years to achieve his glory that would come from this action. And yet Ukraine and the West can play a much, much longer game here. And I think that really is the right way to view this conflict. The loss of life has just been tragic, of course, but from a military standpoint, this is giving the U.S. the opportunity to just grind down the Russian military machine. There are so many stories that we could talk about, so many aspects to this for folks that are aware of how our military functions and our diminished expectations for what Russia could ever do if they came into combat with us. We have such a strong military, so professional, so well trained, and it's a learning organization. The Russian military machine, not so much. And they have just walked into a meat grinder. And I think the real game is just how much advanced weaponry we send, because it's probably in our interest militarily to continue to dispose of Russian military capability, and that's exactly what's going on. But the big gamble here is, when does Putin decide he has no other reasonable exit to take other than perhaps using tactical nuclear weapons? And that's the thing that we hope doesn't happen. I really couldn't tell you what the stock market might do, how capital markets in general might react if we suddenly find that we're in the middle of a nuclear war, even if we say it's only tactical nukes. I think that probably is going to be very bad for the markets. The other big global conflict that we've been talking about is Taiwan and China. There, I think that it's China that's playing the infinite game, and the U.S. and everyone supporting Taiwan is really just buying time, if you will. It's not written in stone, but seems kind of inevitable that China will eventually get Taiwan. They're gradually ratcheting up the pressure. I think China has watched what's happened in Ukraine with great interest. And, I think China has 2 aircraft carriers. They're not nuclear. At least one of them is a used Soviet carrier. When you compare that to our 11 carrier battle groups, there really is no comparison. To absent the use of nuclear weapons there, and I don't think anyone thinks that's about to happen, the Chinese military is really no match for the U.S. military and our ability to project power overseas through our naval resources. But China might decide at any point in time that the U.S. doesn't want to be fighting 2 battles, because we're really fighting one in Ukraine. Do we really want to be expending the resources here as well? But even if they don't decide that the time is right for the takeover of Taiwan, they can just continue to ratchet up the pressure. And we've got so many economic links to the Taiwan industrial base that would certainly be bad for the markets and bad for our economy. The next big disruption is artificial intelligence, and we spent quite a bit of time talking about that a quarter ago. I'm showing a chart here from Goldman Sachs that says, maybe it's 37% of jobs in the U.S. don't need to worry about AI, but much of the rest of that other kind of 2/3, if you will, could see about 40% of what we all do be replaced by AI. So if you're in one of those 2/3 of workers in the U.S. where a lot of what you do could be replaced by AI, you might need to worry. Now, from an investor standpoint, this idea that AI might replace 270 million jobs globally and increase GDP by 7% is probably going to generate some really nice returns in the stock market if you're diversified. So again, from an investor standpoint, that is not bad news at all. But even Goldman Sachs acknowledges that they might not be right about that. And Uplift, which is a UK firm looking at the UK market, says that in the UK, AI might add about 2.5 million jobs, but it could take away more than 13 million, and that's only a 19% replacement rate. So we don't know what the future holds for the global economy and even for the US, but I'm kind of glad that we're coming into this new technological era from a position where we don't have enough workers, where we have so many people participating that we could afford for many to go back to the sidelines, where the demographic trends are for a lower participation rate. And we could easily see the unemployment rate go up several percent and be just fine. I think that's likely to happen. This is going to be chaotic as it unfolds. And we're just trying to look ahead the next 10 years. After 10 years, it's a whole new ball game. And despite what a few people that have approached me have said to me, where they speculate this could take a very long time to unfold, what I'd offer back is that it's happening right now. And we talked through some of those examples a quarter ago, but artificial intelligence is upon us now. So we should be ready for disruptions, and the winners and losers in the stock market are going to be pretty darn hard to predict. I would not want to have too much in any one stock right now. So let's talk about the BIP Wealth Toolkit. And many of you have seen this slide before. You know, we have allocations to cash and fixed income and public equity, just as any investment advisor and pretty much any investor does. But in addition, we run some rather sophisticated option strategies. BIP Hedged Yield is a fixed income substitute that's done great. BIP Hedged Equity takes some of the volatility off of an allocation to equities. Private fixed income and private equity are their own special case, however, and it was certainly nice last year when most of our private fixed income was earning around 12% when the index was down 13%. Private equity has bought an awful lot of new homes for our clients. So I don't have to tell most long-term clients how valuable that is, but we're adding two new ones, BIP Short-Term Tactical and BIP Concentrated Stock, to the toolbox. So we're just going to pause here and talk about those for a minute. BIP Short-Term Tactical is a new strategy that allows us to take advantage of the fact that we can go in and invest in the treasury markets and generate returns where we don't have to worry about FDIC coverage rates, right? That's a pretty important thing these days. And B, generate returns that we expect to be higher than anybody can go out and get by putting their money on deposit at banks. All of this pressure on bank balance sheets is likely to lead to lower offered yields on depository accounts. And while there's a gap right now, for instance, we can go into BIP Short-Term Tactical and invest in floating rate treasuries and earn yields that are into the 5% range. You know, we see what's going on with banks, and we see that that's a gap of maybe 1% or better. We think that gap's going to only increase. We think that gap might be 2% or more within just a matter of months. So BIP Short-Term Tactical is great as a place to stash money if you've got money that's sitting in a bank somewhere, making 3 or 4% even. We think we can do a lot better than that. And again, not really have to be worried about the same FDIC limits, because when you own treasuries, you have the full faith and credit of the U.S. government behind them. But BIP Short-Term Tactical is useful for another reason. I think of my role as a portfolio manager, and I still enjoy trading client portfolios on a daily basis. You know, we have a lot of clients that have money coming in and money going out on a regular basis. It might be because of their own personal financial situation, or maybe they're consistently investing in the private markets and then getting the exits and the big quarterly returns that come from the private fixed income coming back in. Well, if I'm trading your portfolio and I'm trying to keep it at 60% in equities and 40% in fixed income, for instance, that money in and money out might be causing me to trade in a manner that's otherwise wouldn't be necessary. So I think a lot of our clients could benefit from an allocation to this BIP Short-Term Tactical strategy that kind of handles all the money in and money out. The other strategy, BIP Concentrated Stock, is really there because we know we've got a lot of clients that have a big position in one stock. And I wish I could predict how AI and some of these other things might affect any one stock, but I'm really not sure. And I don't think anybody knows. It's tempting to think that some of the big tech companies are going to be the biggest beneficiary of their investments in AI, but it might just be that it's the users of AI that win. What I can tell you is that if there's an industry that can benefit from AI and some of the competitors are employing it, it's very likely that they will dramatically outcompete the companies that are not using AI. It's just such a pickup in productivity and efficiency and value that there's going to be a big dividing line there. So who knows whether it's Google or Microsoft that wins the AI war? Who knows which firms in any given industry are going to be the best users of it, but this is just not a time to have too much in one stock. So if somebody's got, let's say, $500,000, certainly $1 million or more in one stock, we can use our options experience from hedged equity and hedged yield to cut the daily volatility of that stock market exposure in half. And sometimes that's a lot better solution for clients than just outright selling of that stock. So let's wrap things up with our final thoughts. We have these key themes for 2023. We will continue to revisit them. If you want to look at how we presented that at the beginning of the year, you can go back to our YouTube channel and search for BIP Wealth and watch what we were saying 90 days ago. I'll remind folks the economy is still very strong despite what the Federal Reserve has done. And while the Federal Reserve might still continue to raise rates, I think we should all feel a bit of confidence around that strong economy. Investors have been winning, and even if the headlines you're reading aren't telling you that you've been winning, if you've been diversified and been a client of ours, you know, you've experienced the market going up for 2 quarters in a row now. It is perhaps timely to call out that despite all of our best efforts and everyone's best efforts in financial services, there is one final risk that remains unhedged, and that's just about the debt ceiling that's in the news so much. I think that there was some news about that today that wasn't particularly good, but I'm sure folks will be back at the negotiating table very soon. If we were to find ourselves in a situation where the debt ceiling is not lifted and the U.S. defaults on its obligations, it's probably really bad news. No matter how good or bad the economy is, U.S. Treasuries are still the safest security. So if you think of a situation where U.S. Treasuries come under risk, well, I wouldn't count on FDIC insurance. I wouldn't count on any corporate bonds. I certainly wouldn't count on any stocks to save the day. Everything else is going to be riskier than treasuries. So anything that threatens treasuries threatens everything else and then some. And we don't know how this would unfold if the U.S. were actually to default, but certainly there is a time when, you know, the electricity is not flowing, the ATMs aren't working, grocery store shelves are empty, the water is turned off, because all of those infrastructure pieces that we count on in our daily lives are built around a financial backbone that has to function and requires for U.S. Treasuries to function. So there's very likely no winners in that kind of situation where things unfold. And you know, the idea there about hedging that risk really comes down maybe to having some, you know, some food and water stored somewhere safe that you can get to, and the ability to protect yourself. And we don't really like to think about that, but there's not much that financial services firms can do to help you if we default on our national debt. And that wraps things up. I think we've already got some questions coming in. Bill, did you want to step in now that the questions are rolling in and help me out with what we should answer next?
Absolutely. So thank you, Eric. The next question we have is, how will the economy be affected by the influx of huge dollars that the federal government infrastructure programs have been paying for?
Sure. So it is stimulative when the government spends money on infrastructure programs. And the question is, can we tolerate that stimulus? We have the Federal Reserve trying to hurt the economy, if you will. You know, the Federal Reserve would like to make your house more affordable should you choose to sell it, which means take some value out of it. And at the same time, we don't have any extra workforce available. So when we spend extra money on infrastructure investment, the question arises, where are we going to get the workers to do the work? And might that even contribute to inflation? So I think that it will cause the labor market to continue to be tight for some time to come. And I say that with the caveat that I think AI is going to replace some jobs and perhaps make some more workers available for something like this. I think this is going to give a little bit of pressure towards inflation staying higher, even though in general it's on the way down. And I think it will continue to stimulate the economy in a way that frankly will benefit investors. So it's a bit of a mixed blessing. I wish we had more workers available right now. And we probably don't really need the economic stimulus. If it stimulates the economy too much, then the Federal Reserve is just going to raise rates and try to crush that economic growth even harder. So it's going to be interesting how those two forces play out.
Good deal. Thank you, Eric. You'll love this next question because we've talked a lot about this in our investment committee. This one from Robert. How has the move to remote working affected commercial real estate? Is that trend putting continued pressure and it has already done its damage in the real estate market?
Well, it is a great question, and I think it's going to continue to put pressure on that market. Just looking at our own industry, the headlines 6 months ago were that a lot of Wall Street firms were now forcing their employees to come back. But that has since reversed. And a lot of folks have had second thoughts about that. In New York City in particular, they're trying to get firms to agree to force workers to come back. But workers that sit in front of a computer all day and are on a webcam all day are able to be pretty effective. And so I think firms that are looking for deals and to lower their own costs are doing a thorough examination about which workers need to be in an office and which workers can work remotely. And so the technology continues to get better and better. And in our own firm, we've got a lot of folks that work from home. However, we're expanding so fast that we are finding more space in our Buckhead location. We just opened an office in Nashville. We're finding more space in our Alpharetta location. So, we're expanding the number of people that come into work while also expanding the number of people that work remotely. But as we go into those markets and talk to landlords, we're looking at the fact that other firms are not sending as many people to work, and that's creating a lot of pressure. Now, most firms have long-term leases, at least 5 or 7 years, and in many cases, much longer than that. So we're going to see this pressure play out over the coming years as these leases get renegotiated. Most famously in the news just in the last few days is the fact that Twitter, now under Elon Musk's full control, simply refused to pay its rent. And it said, we'll take that risk and work on that through the lawyers, but we'd like to cut those costs. I don't know how widespread that is, but it's certainly a symptom of what's going on in that market.
Good. We've got a lot of energy on the questions this morning, Eric. So how about this next one from Lee? Is the unemployment rate among white collar workers higher than the average rate that you shared? Based on the media, it feels like companies are shredding salary-based workers. Or is it just a correction from overhiring during the pandemic? Or is this just a sign of what's to come with artificial intelligence?
Lee, that's a great question. And what the data shows me is that we're seeing lots of headlines that we simply cannot extrapolate to the broader market. Now, we'll see specific areas, and marketing might be one of those, where there are sudden efficiencies that can be achieved with AI that simply did not exist 6 months or a year ago. And that's going to be very industry specific and even firm specific. But while we're talking about the broader level of unemployment be in the 3% range, for workers that have a college degree and are at least 25 years old, the unemployment rate has now dipped below 2% to, I think the latest month showed it at only 1.9%. So if you're in the market for white collar workers and you define that as having at least a 4-year college degree and being over 25, that unemployment rate has never been lower. 1.9% is just about as low as you can get it, because there's always going to be some friction from people changing jobs. So really the actual data is 180 degrees from what the headlines are saying, at least in the aggregate.
Good deal. The next one from Will, can you talk about the economic impacts of the immigration issue that is grabbing the headlines right now?
Sure. Immigration is a politically charged subject, emotionally charged subject. But the way we view things from an economic or investor standpoint is that much of what happens in immigration doesn't really have an immediate impact on what we're talking about. Now, there's exceptions to that when you have workers coming over, in particular to work in the construction industries or the farming industries. That can have more of an immediate impact. But in the broadest sense, immigration into this country, certainly illegal immigration into this country, has an impact a full generation later. And the classic model for that is that workers coming into this country illegally don't necessarily get the full benefit of government services, and certainly are not paying taxes at the expected rate. But the next generation, so the children of those immigrants, tend to be fully working within the system. So there's a generational lag. So that can be a couple of decades before we get that. So when we talk about needing more workers right now, illegal immigration is not likely to solve that. Although again, and you see this in the headlines too, it might solve it to some degree with landscaping and construction and farming and other industries that have historically employed more of those workers. So our costs tend to go up right away, and the benefits come later from taxes. That being said, there's other immigration that could be part of that conversation. Legal immigration for highly skilled workers, folks coming in pursuing their green card through all legal means. And because our labor markets are starved for talent from the top to the bottom across industries, that legal immigration can help our rate of economic growth right now.
Good deal. Eric, we've had a couple of other write-in questions. So to talk a little bit about BIP comprehensive investment strategies, how does our strategies protect us against severe inflation?
Sure. Well, inflation had a dramatic impact on market returns last year because it caused the Fed to react in a very volatile way. So, we pursued a strategy with our public fixed income to take most of the risk of rising rates out of the equation. The fixed income index set records last year with being down 13%, which was more than double the worst year ever before that. And most of our investors enjoy much better returns than that. So they might have been down, but we're down a lot less. Also, when we look at what we did in fixed income on the private side, it was a completely different ballgame. We were able to do things that we simply can't do in the public markets. The perfect example is when our investors were putting their fixed income allocation into vehicles that own what we call senior secured debt. It's the safest debt, or maybe the only debt that these companies even have. Pretty low loan to value ratios. So we regard those as pretty safe assets. But on top of that, those returns were floating rate returns. And we used to talk about what they earned relative to LIBOR, the London Interbank Offered Rate. And that was the floating rate that so many loans were pegged to. Now we go to SOFR, which is a different metric because LIBOR is going away, but it's the same principle. It's a floating rate. So when the prevailing rate goes up, the return on those fixed income investments goes up right with it. So in that sense, you really don't have a worry about inflation. Stocks tend to survive inflation reasonably well. In the short term, at least, most of the pain is in fixed income. So again, in both the public markets and the private markets, we had solutions in place for a large number of our investors that at least protected them, or in a few cases, absolutely immunized them against the impacts of inflation, which is why we had a number of clients last year, tended to be the ones that had done the most in private markets, actually were positive for the year.
Another write-in question, Eric. When you talk about international equities, you talk about the valuation of the dollar. And so what if we go through a situation where we have a severe devaluation of the dollar? How does that impact the BIP wealth portfolios?
Well, it's not intuitive for everybody, but at least in the short run, when the dollar is depreciating or being devalued, your best investments might be the ones that are overseas. By implication, those foreign currencies are increasing in value. So we don't really have much allocation to foreign debt within our fixed income portfolios, but we do within equities. Now, we overweight the U.S. by a bit, historically at least 5%, and we've been making some moves lately to make sure that we're keeping that margin. But all those foreign equities in developed markets and emerging markets are in other currencies that are strengthening in that scenario. And so when you're investing in foreign equities, you're really investing in that foreign currency and you're investing in those foreign markets. And so you get a boost as a US dollar-based investor when those foreign currencies appreciate. So it would give us plenty of time to adjust our broader strategy if we thought we needed to in response to that stress. But in the short run, at least, it would be a terrific boon for our clients' portfolios because their foreign equity investments should do especially well.
Good. Thank you, Eric. That concludes our Q&A session that we have. So thank you for the presentation today. Most importantly, thank you for all of you that attended today. We really appreciate you joining us on our quarterly market report. Hope all of you have a wonderful rest of your day and enjoy your weekend. Thank you very much.
Thanks, everyone.